Loans are when one party gives money to another party in exchange for that amount to be repaid, usually with interest. They can help borrowers out of a bind, assist borrowers in purchasing expensive items, or advancing their careers, or may even be used by unscrupulous lenders to take advantage of the desperate. Understanding the basic types of loans can help borrowers recognize which ones are appropriate and can even help them get better deals. In this video, we'll go over the basics behind nearly every type of loan, most of which fall under consumer loan options, small business loan options, and crowdsourcing and other non-traditional loan sources. And check below in the video description where we will note the times for certain sections if you want to skip to specific types of loans. First, let's cover consumer loan options, starting with personal loans. Personal loans from institutions. Personal loans are a common way for consumers to get money from banks or credit unions. The money is paid in a lump sum and is paid back over a set amount of time. Personal loans from friends or relatives. Asking a family member or friend for a loan is another common way to get money, and a more formal document like a family loan agreement can help minimize the risk of relationship damage from a family loan or an IOU gone wrong. We have free templates for these available at the link in the description below this video. Payday loans. Payday lenders loan money to people by letting them borrow against an upcoming paycheck. Despite attempts to regulate payday lenders, they can still charge exorbitant fees that wind up being multiple times the value of the loan if the borrower can't repay them quickly. Also falling under consumer loans are auto-based loans. Auto loans. An auto loan is a loan specifically for the purchase of a vehicle where the vehicle itself is used as collateral for the loan. This means that the lender can repossess the vehicle if the borrower falls behind on their payments. Car title loans. A car title loan puts the title of the vehicle up as collateral for the loan, which means that the lender can take the car if the borrower does not repay the loan on time. Because of the high fees and the short terms, they usually wind up being not a very good deal for the borrower. Much like car loans, there are several consumer options for home-based loans, like mortgages. The mortgage loan is the most common method for people to purchase a home. The lender provides the funding for the purchase of the home, which the borrower agrees to pay back over a certain period of time. Home equity loans are a lump sum loan that is repaid over fixed monthly payments that is based on how much money you have put into paying off your mortgage. Typically, a home equity loan will allow you to borrow up to 85% of the equity in your home. Like a mortgage, the home equity loan uses your home as collateral and can take your home if you default on the loan. Reverse mortgages are a type of home equity loan where the bank pays a homeowner age 62 or older a set monthly amount based on the equity built up in their home. These payments continue until the homeowner dies, sells the home, or moves away. At that point, the loan is repaid either by the bank taking the home or by the loan being repaid in full. Next up, credit-based loans. Credit cards are a common credit-based loan. Each month, the borrower can borrow up to the limit set on the credit card and pay it off without interest. If the month passes and there is still debt, then the borrower is charged interest on the debt. A personal line of credit is like a credit card, just without the card. Like a personal loan, a line of credit allows the borrower to receive a certain amount of money. However, like a credit card, the line of credit remains open once the borrower has paid it off, allowing the borrower to use it whenever it is needed. A home equity line of credit is like a home equity loan that the borrower can use whenever they need extra cash. Provided that it is paid off within the allotted time, it's essentially like a personal line of credit, but it uses your home equity as collateral to secure the loan. Student loans. A student loan is a loan that a student takes out in order to pay for higher education. Unlike a personal loan, student loans are generally meant to be for school or school-related items such as books, housing, food, and transportation costs incurred while going to school. The federal government subsidizes loans for students who meet certain requirements, while other students who don't qualify choose between unsubsidized federal loans and private loans. Next up are small business loans. In addition to consumer loans, there are an entire class of loans dedicated to entrepreneurs and small business owners to help them make capital improvements, manage economic uncertainty, and accelerate growth. Many of these tools are similar to their consumer counterparts, but structured with business owners in mind. Business line of credit. Just as consumers can secure a line of credit to help them handle unexpected financial hurdles, so too can many small business owners. Business owners can get a line of credit, giving them anywhere from $1,000 to $500,000 to help them manage their businesses, with rates that usually range from 8 to 24%. Business credit cards usually have a higher interest rate than business lines of credit, but they incentivize business owners to choose them by giving them greater flexibility as well as access to various rewards programs that could give business owners who use them responsibly a healthy boost. Business term loans. Think of this as the de facto type of loan for most small business owners. Structured like a personal loan, the business term loan allows a business owner to borrow up to $2 million and then pay that money back over the period of 1 to 5 years. Business term loans generally have very attractive rates. Short-term loans are like the standard business term loan, but as the name implies, they usually get paid off over 1 to 3 years. They have slightly higher interest rates, but they are built for speed. Equipment financing loan. Equipment financing loans are created for the express purpose of purchasing or replacing equipment. Because of this, they have a fast turnaround and require less extensive documentation. Despite that, equipment loans have limits of up to $5 million for businesses to purchase the vital but sometimes pricey tools that they need to make their business run. Accounts receivable financing loan. This is something akin to a payday loan for a business. With accounts receivable financing, a lender agrees to purchase the business's outstanding invoices or receivables. In exchange, the lender provides an immediate infusion of cash to the business and assumes the risk of non-payment for the outstanding invoices. Because of the risk, the interest rates or fees associated with accounts receivable financing are usually higher than other forms of small business lending. SBA Loans. The U.S. Small Business Association helps business owners acquire SBA loans through a large network of participating lenders. Generally, these loans of between $5,000 to $5.5 million are only available to business owners that have already exhausted their other loan options. If all of these prerequisites are met, the SBA loans can wind up to providing business owners with some of the best annual percentage rates on the market. Startup loans. A startup loan can help an entrepreneur scale up their business in many ways, like leasing office space, hiring employees, developing prototypes, or purchasing equipment. These loans take many forms, from SBA loans to business term loans to credit cards or lines of credit, but they're all tailored for startups. In addition to all of these options, a new loan option has popped up online in the past decade: crowdsourcing. A relatively recent innovation in the lending world, crowdsourcing gives both consumers and business owners the ability to make their case to the internet in hopes of getting a large quantity of microloans from people online who are moved by their story. In some cases, the money doesn't even have to be repaid. The crowdsourcing site usually takes a cut of the final amount raised, and the rest goes to the recipient. Other times, lenders will back a crowdsourcing campaign in exchange for a gift that the campaign designates for those who hit certain tiers. While this sounds great in theory, crowdsourcing is hardly a guarantee. Many campaigns have difficulty cutting through the noise of the thousands upon thousands of other pleas out there, elbowing into social media feeds trying to be heard. Also, depending on the site, certain campaigns are only funded if they meet a predetermined threshold, meaning that the borrower could put in all of the effort of building and marketing a campaign only to see it fall short of its goal and receive nothing. No matter which options you choose, loans come with undeniable risks. They also unlock the potential for unlimited rewards. With the proper planning and research, consumers and entrepreneurs can leverage their buying power through shrewd borrowing to achieve personal and professional advances that would otherwise be out of reach. we're eForms, the biggest database of legal documents. For more information about loans and for free loan form templates, check out the links in the description below this video.